All right, today we are going to pull back the curtain on one of the most common tools you'll find on any financial chart, the moving average. We're going to uncover the hidden story that this simple looking line is telling us about the market. So, you've seen this line before, right? Gliding through the price action on a stock chart. It might look kind of simple, but really, it's a visual map of market psychology, of momentum, and even potential turning points. Today, we're going to learn how to read that map. So here's our game plan. First, we'll cover the basics, what a moving average even is. Then, we'll get into the really cool part, the psychology of why it works. From there, we'll see how it acts as a floor or a ceiling for prices, learn its most famous trading signals, and wrap it all up with some super important pro tips and pitfalls to avoid. Okay, let's dive right in. We need to demystify this line and build a solid foundation. So, what in the world is a moving average? Well, technically, it's exactly what it sounds like. It's an average price that's always updating or moving. By averaging out the price over, say, 5 days or maybe 50 days, it smooths out all that chaotic, jumpy price noise. And what you're left with is a much, much clearer picture of the real underlying trend. But here's a much better way to think about it. The 5-day moving average is basically the average price that everyone who bought in the last 5 days paid. So think about it. If the current price is above that line, the average recent buyer is making money. If the price is below it, well, they're losing money. That one simple idea is the key to everything else we're about to talk about. And that's our cue to get into the most fascinating part. See, understanding moving averages isn't really about the math at all. It's about understanding people, the collective psychology of the market, that constant tug-of-war between fear and greed. Imagine this. We're in a strong uptrend, prices are climbing. When the price dips back down to touch that moving average line, it's like a sale. New buyers who were waiting on the sidelines see a chance to get in at the average price, a perceived bargain. So they jump in, that demand pushes the price up, and that's why you so often see the price bounce right off the moving average and keep going higher. Now, flip that completely on its head for a downtrend. Anyone who bought recently is sitting on a loss, they're feeling trapped. So when the price rallies back up to the moving average, what do? They see a golden opportunity to sell and get out at their break-even point without losing money. All that selling, that flood of supply, hits the market and bam, it pushes the price right back down again. And you can see that psychology playing out right here on this chart. Just look at how the price respects these moving average lines. It bounces off them in the uptrends and gets rejected by them in the downtrends. It's literally a visual map of that battle between buyers and sellers we were just talking about. This behavior, this bouncing and rejecting, leads us right into the next way we use moving averages, as these moving, dynamic levels of support and resistance. You've probably heard of support and resistance. Support is like a price floor that stops things from falling, and resistance is like a ceiling that stops them from rising. Well, moving averages act like flexible, curving floors and ceilings that actually move along with the trend. And here's the simple rule to remember. When the price is trading above the moving average, that line acts as a support floor. But the moment the price falls below it, that same line flips its role and becomes a resistance ceiling. It's the same line, but its job completely changes depending on where the price is. Okay, now we get it. We understand the psychology. We know they act as support and resistance. So let's talk about two of the most famous signals in all of finance. And they both come from moving averages. I'm talking about the golden cross and the death cross. A golden cross is when a faster, short-term moving average crosses above a slower, long-term one. It's seen as a really bullish signal, a sign that a new uptrend could be starting. And the death cross? You guessed it. It's the exact opposite. The short-term line dives below the long-term one, signaling a potential new downtrend. And this slide just shows it perfectly. Over on the left, you can see that short-term average punching up through the long-term one, and look what happened right after, a major rally. Then on the right, you see the opposite. That line dives below, and boom, a sharp drop follows. These are really powerful visual cues that the whole market is watching. Now, these signals look awesome, I know, but moving averages are absolutely not a magic crystal ball. So let's get into our final section and talk about how to use them smartly, and more importantly, what to watch out for. First pro tip, and this is a big one. Not all moving averages are created equal. The longer-term ones, like a 60-day or a 200-day, are based on way more data, so they represent a much more significant trend. A bounce off the 60-day MA carries a lot more weight than a little bounce off a 5-day. The longer the time frame, the stronger the signal, period. Okay, now for a major pitfall. Remember, moving averages are trend-following tools. That means they work great when the market is clearly trending up or trending down. But in a choppy, sideways market like you see here, they become a tangled mess. The lines just get all twisted up, they cross back and forth, and they spit out tons of false signals. Seriously, in these conditions, it's often best just to not use them at all. And this brings us to the single biggest weakness of moving averages, something you have to understand. They are, by their very nature, lagging indicators. They're calculated using prices from the past, so they can only show you a trend that's already happening. They don't predict the future, they just confirm the recent past. And this chart is the perfect example of that lag. Look at this. The market topped out way up here and started to fall off a cliff. But the death cross signal, our supposed warning to sell, it didn't actually show up until almost a month later, after a huge chunk of the drop was already over. You always have to remember there's a delay. So let's wrap this all up with the key takeaways. First, longer-term moving averages are more reliable. Second, avoid them like the plague in choppy, sideways markets. Third, please use them as a guide to confirm a trend, not as a crystal ball to predict one. And finally, and this is probably the most important, never, ever use them all by themselves. Always combine them with other tools to get the full picture. So you see, the moving average isn't just a line. It's a story about the market's consensus. It's a story of profit, loss, hope, and fear, all smoothed out for us to see. So the real question is, now that you know how to read that story, how are you going to use it to read the market?